Okay, today we will analyze how we can allocate assets in a portfolio. But before doing that, please take note of this disclaimer. I am not a financial advisor. I am not giving investment recommendations. You should do your own homework and take your own decisions. This is not an investment advice. This is an academic or a teaching session. Okay? Clear on that? All right, let's continue. So, suppose I have 5 assets and I want to allocate the capital that I have for investment. And how should I allocate the capital based on what? So, first of all, I downloaded the historical values of gold. This is gold. I downloaded historical values from the 4th of January 2021 until the 16th of May 2025. Okay, so you can see there were 1,124 entries. Okay, the same was done for natural gas futures, which is a commodity, silver futures, which is also a commodity, the dollar, which is an index, Kuwait USD, Kuwait dinar against USD, and which is forex, and GBP USD, Great British pounds against US dollars. So I use that historical information to date to build this table you can see here in yellow. We will now analyze the inverse coefficient of variation weighting. How to use the inverse coefficient variation to assign weights for each asset. Okay. So first of all, each asset we have calculated the mean, okay, which is simply the average on the closing price. Okay, so for example, for gold, it will be the average of all these prices here, okay, until the end. It can be also the average of the open price, by the way. It doesn't matter. But you have to be consistent. If you start with the last price, all your calculation has to be in the last price. If you start calculating on the open price, all your calculation should be on the open price. Okay, then we have the standard deviation, which is, I'm not going to teach here how to calculate because we already covered this in previous lessons. But basically, the standard deviation is just calculating the mean of the prices and then subtracting the price from its mean, then squaring that difference, and then finding the square root of that value. That's the standard deviation. So what is the definition of standard deviation? Is how much it deviates, it fluctuates from its mean. The higher the deviation, the more volatility. So based on that, there is a coefficient variation. And this coefficient variation is telling you the percentage of volatility. For example, gold has a CV of 18.92%. Natural gas 46.85%. Silver 15.19%. Dollar index 5.60%. Kuwait dinar 0.86%, and GBP 5.30%. So basically, from this simple list here, we can tell that the less risky asset is Kuwait dinar with a very almost zero variation, 0.86%, less than 1%. It's 6 times more stable than the dollar, 6 times more stable than the dollar. So based on that, we calculated the inverse of this coefficient, which is simply this coefficient to the exponential -1, and we distributed the weights accordingly. So based on this, the weights is shown in the graph to the right, okay? Here. So you can see that 69.69% of your assets, of your allocation, should be for the Kuwait dinar, okay? Then on the second place, 11% on GBP and 10% on dollar, 3.93% on silver, gold 3.16, and the last asset to hold is natural gas because it is too volatile. It shows a very high standard deviation, very high coefficient of variation or volatility. So this is one method, okay, that is called the inverse coefficient of variation weighting, because you are calculating the weight on some inverse coefficient. This another way of doing, which is much more complex, and it's based on the modern portfolio theory. It's called the minimum variance portfolio. The minimum variance portfolio not only considers the variance itself, but the correlation between assets. Okay, so you can see here that we listed our 6 stocks on a horizontal line, and then our 6 stocks on a vertical list, and we compare gold against gold, because when you compare variances, you have to build matrices in pairs. So we compare gold against gold, gold against natural gas, gold against silver, gold against dollar, gold against Kuwait dinar, gold against GBP, and then natural gas against gold, and so on. So you have 36 different matrices. Okay, with these matrices, we build our asset allocation, which I'm not going to explain here because it's extremely complex. Okay, I'm not going to explain the mathematics of it. I'm just explaining the general concept. So from this asset allocation, we can see that we can hold 0.59% in gold, less than 1%, negligible in gas, 0.01 of natural gas because it's extremely volatile, 0.33% in silver, 4% dollar, Kuwait dinar outstandingly overweighted by 101.11%, and GPB by -6. Why this is -6? Because all these upper positions will be long positions, and I can hold a short selling position on GPB to counterbalance the correlation between these assets. So you can see if we add all this together, should be 100, so 0.59, 0.01, 0.29, 4%, 101.11, and minus 6 is adding to 100%. The sum of, you see, this is 100%. This is a graph that shows that how I allocate my capital within the assets. So I will have a very overweighted exposure on the Kuwait dinar because it's the safest asset, and I will have a in a long position, and I will have a very a minimal exposure on dollar at 4%, also long position, and a slightly higher short selling position on GBP. Okay, so we can see that there is quite difference between the inverse coefficient of variation weighting and the minimum variance portfolio, because the minimum variance is trying to minimize to the maximum, is trying to minimize the variance or the deviation from mean or the volatility. And it is also considering the correlation that exists between assets, because some asset, when they go up, another one go down, or in a stronger or weaker way, and vice versa. Okay, or they go up together or they go down together. I mean, there is a lot of mathematics behind that. So if we will go through the modern portfolio theory, we should allocate based on minimum variance portfolio, the MPV. Okay, guys, I hope this lesson will prove helpful. Thank you.